Welcome back to the channel. A lot to unpack, a lot to talk about this week. For a lot of Canadians, whether you're purchasing or refinancing your home, there are generally 5 mistakes that I see pop up often that cost Canadians thousands of dollars and headaches during the entire process. So this week, I want to go over those 5 mistakes and help to keep that money in your pocket and avoid a lot of these problems. So stay tuned. Once again, thanks for stopping by. If you have not subscribed to the channel, please consider subscribing. Don't forget to like, share the video, hit that notification bell, but more importantly, let me hear from you in the comment section below. Let's kick things off with mistake number 1. Now, this should go as no surprise. We've talked about it at great length on the channel, but I still see this happen often. It's number 1, avoiding or getting the wrong pre-approval or not getting a pre-approval at all. So generally there's the pre-approval, which is what we like to do. That is where you're underwriting, you're collecting all those documents, all the vital documents that are needed to review the income, the down payment, the credit, all the good stuff, right? That's generally a fundamental pre-approval. And if you're not providing that information to your broker, then you need to ask yourself a few questions. Is it a pre-qualification that I'm doing? Am I doing this online? Are you doing this, directly through questions that your broker's asking? And more importantly, is that pre-qualification accurate? Because once again, if you are not collecting the documents, having a trained professional reviewing that income, whether you be self-employed or if you're commission-based, maybe you're hourly, there's different ways that the banks will look at that data. So understanding those two differences. But the third one that's come up very often is what's called just a rate hold. So some Canadians will say, hey, I went to my bank, or hey, I talked to this person and they did a rate hold. This is a big problem because a rate hold is just as the name implies, it's holding the rate. Potentially no documentation was collected, no credit check was pulled to validate the meat and potatoes of what is the applicants that are on the file, how the bank's going to look at that. So understanding that if you're doing that, it doesn't necessarily constitute a pre-approval. So understanding what you're looking for is super, super important. And once again, in the description box in this video and every single video, we have a link to our app, our free app to download. And there you'll find all the tools and calculators to help you, and even a pre-qualifier there. If you want to get a pre-approval, tell you how to get that done. So ultimately, some great advice, some great tools in that app. Now, let's move on to mistake number 2. Now, mistake number 2 is more directed to first-time home buyers, and that is, forgetting or, not calculating for closing costs in the mortgage journey. Although generally, when you're even refinancing your home, there are costs to close that refinance. Sometimes we're adding that into the amount that we're refinancing for, so you're not coming out of pocket, but you need to factor in all these equations. So if you're buying a home and you're approaching closing, or you're approaching the pre-approval process, is understanding what to budget for. Now, when you're working with your mortgage professional, they should give you a very high level, detailed amount of how much you should be considering what's going to cost you to close, right? So number 1, the big thing in the closing cost is the land transfer tax. How much is that going to cost me? Am I a first-time home buyer? What is the difference between what I'm getting as a credit and what I'm going to have to pay? Are both people on the application first-time home buyers? Am I eligible for the full amount? Obviously, that information may come from your lawyer, but we suggest and always advise, if you're buying, especially with an insured mortgage where you're buying with less than 20% down, most banks, all banks actually, are going to ask you for the proof that you have the closing cost available to you. And generally that's around 1.5% of the purchase price. You may want to buffer that up a little bit higher, depending on what your circumstances are on that purchase price of that home. The reason we say that is because let's say you're going through the pre-approval process, right? And you may have $60,000 or $70,000 at your disposal, but that is all the funds that you have. It's super important to understand that you need to pull back or scale back that down payment in order to cover the closing cost, or, have a conversation with your broker. We're always asking the question, is that including closing costs? Is that not including closing costs? And then ultimately figuring out what the structure is, what the plan is, because you can always save up for the closing cost and then show the lender at the end. But if you're putting more than 20% down, the banks don't ask you to provide proof of those closing costs, but it's still there and you need to be aware of it. So that's mistake number 2. Let's move on to mistake number 3, and that's misunderstanding the stress test rule or where it's applicable and not applicable. We still get questions on this all the time. And I heard that there's no stress test. Well, that's not the case. We have the stress test in Canada. There's conversations that may change maybe next year into a different rule. Obviously, we'll see how all that plays out. But as it stands right now, if you're purchasing a home or refinancing a home, that means you need to undergo the stress test. That is the contract rate. That is the rate that you are being given by your broker or your bank plus 2%. So now, ultimately, that's important to understand when it's qualifying. That's going to determine how much money you can borrow and what your maximum purchase price will be. The only time that there is no stress test applied is if you are transferring or switching that mortgage from one lender to the other, and both of them are federally regulated, or you're moving into a federally regulated bank. That means you do not have to undergo the stress test. As long as you're not asking for new money, we're not making any material changes to that mortgage. There are a lot of particular nuances within this. If you're going from a broker-friendly bank per se into a major bank, or vice versa, from an equity lender, an alternative bank into a conventional bank, or vice versa, sometimes these rules do not apply. Sometimes the banks will still do their own stress test. So having a conversation with a mortgage professional who understands these rules, these guidelines, and works with more than just one lender can help you keep money in your pocket and potentially help you to qualify for every single dollar that you may need, obviously, and that you are eligible to qualify for. Just because you can, though, doesn't mean you should. So let's get into mistake number 4. Mistake number 4 is making material changes that could impact your qualification or approval or mortgage. So ultimately, material changes. Get this question all the time. If I had $1 for every email I got regarding this question, I'd be a very wealthy man. So here's the question: I want to go purchase furniture, and I need to buy a new car, and my job is being switched over. I'm getting a promotion. I might be moving to a different employer. Now, these are really questions that happen during the pre-approval process, during the actual application closing process. Now, generally, the rule of thumb is if you are purchasing a home and you're in the mortgage approval process, you should not be impacting your credit or making any changes to your jobs, especially if you're moving to a different career, if you're moving to a different company, and potentially that company is now from a salary position. Maybe you're going into self-employed, big no-no, big complications for the lender if that's happening. If you're going from a different line of work on your own probation to another job, that could be a major problem. Ultimately, anytime the credit changes, right? If you're, let's say, going into the application with no debt, all of a sudden there's this debt that pops up. And just because you've been already approved for the mortgage, it doesn't mean that the lender can't go back in and check and pull another credit report before closing. Some lenders may even call the job letter a week before the mortgage is set to close, just to ensure that you are still working there. And especially with the uncertain times that we're in right now, with certain sectors of the market being potentially or could be impacted by tariffs or higher unemployment sectors that are more vulnerable, the banks are being very intuitive about this. So you have to understand, any material changes, working with a mortgage professional, having a conversation with them. If there is a problem that could potentially be coming up, is going to help you, because working with a mortgage professional, we have access to multiple lenders. And if there's an opportunity that something happens in life, catastrophic, and we need to switch lenders, we can do that on the drop, basically at the drop of a dime or the drop of a hat, and move and pivot to a different lender if needed. So just make sure, if you can avoid that, try to avoid it. Don't incur any debts. Don't go lease a new car once you're approved. After you get your keys for your home, or you've got the money and you've closed on the mortgage, that's a different conversation. But before that, try to avoid any material changes. Let's move on to mistake number 5. Mistake number 5 is one that I wanted to save to the end. I was grappling between putting it as the first one, but it is always chasing the lowest rate. And ultimately, there's a lot of clients that want the lowest rate. Everybody wants the lowest rate. I mean, I haven't met one person that doesn't want the lowest rate, but ultimately the lowest rate for you and the lowest rate for your product is what's important to understand, right? because there's a trade-off. Sometimes you can go with a bank that may be a monoline broker-friendly bank that may offer you a slightly better rate, that may come with a better penalty if you break the mortgage before your contract is up. You may work with a major bank where those penalties are generally higher, or they offer you a line of credit within the banking process. So you may want the broker-friendly bank because they're better on the rate side, but you may want a line of credit when you're eligible. And within that time frame, you'd have to leave lender A to go to lender B. There could be a penalty there. So understanding that, hey, working with lender B right from the onset might save you more money in the long run. The other thing to understand too is prepayment privileges. Some banks may only offer you 10 or 15% ability to prepay the mortgage down. Some may offer you the ability to increase your payments by a certain amount monthly, right? Depending on the type of product, you may be eligible to do that or not. If you want, and prepayments are a super important part of your mortgage journey to pay your mortgage down faster, you may want to work with a lender that gives you more flexibility in that particular space, because that's going to save you more interest than a 5 or 10 basis point spread on a rate, right? That's super important to understand. You might save $5 or $10 a month, but it may end up costing you thousands of dollars in the long term if you break out of that mortgage for whatever reason. And trust me, we see this happen a lot of times. Clients anticipate or don't anticipate life-changing events. So it's always best to be prepared or work with a lender that has more flexibility in those particular segments, those particular parts of the mortgage. And you're better playing safe than sorry to keep more money in your pocket. And as I guess a bonus tip, of course, I'm going to throw it in there. If you want to avoid all these mistakes, the best way is to speak with a mortgage professional, someone that can ask the right questions, get a better understanding of your best interest. Once again, as a mortgage professional, most mortgage professionals, they are independent. They work for themselves and for you. They don't work for a bank, and they want to make sure that you get the best service and the best advice, and can help you walk you through the process to make sure that you keep thousands of dollars in your pocket. So once again, if you have any questions, feel free to reach out to our team here at InTouch Mortgage Solutions. We'd be happy to walk you through the whole process. And don't forget to subscribe to the channel and leave your thoughts, questions, and concerns in the comment section below. But until next week, we'll leave the video here. Thanks for stopping by.